Good afternoon, everyone. We're just waiting for people to join us. Okay, we will get going. Good afternoon again, everyone. My name is Josh Stripmatter, and I'd like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us. Our presentation today is titled March 2024 Student of the Market. For those of you that don't know us, we are Stripmatter Wealth Management Group, and we are a registered independent advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have any questions, please don't hesitate to type those in, and we will be happy to answer those questions for you. Also, we will be sending you out a replay of today's webinar via email, so if you missed something, don't panic. You will have the ability to watch this again. And you are more than welcome to forward this presentation and any other presentation to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely educational and not meant to be legal advice. So please check with your professionals, your licensed professionals, before taking any action. And then lastly, let me introduce our speaker today, Mark Peterson. Mark Peterson has joined us several times now. He's the Director of Investment Strategy and Education at BlackRock. He is a 20-year industry veteran with extensive experience and expertise in educating financial professionals and investors on market and investment topics. He received his BS degree from Arizona State University. So without further ado, let me hand this off to Mark. Mark, good morning. How are you?
Great. Thanks, Josh. Morning, everybody. Thanks for having me on your call today to talk a little bit about the markets here. Certainly off to a good start for the year. And we'll touch on that. And we'll do it through something that we always share, what we call our student of the market piece, something we send out to advisors on a monthly basis, just with some ideas, thoughts on what's going on in the markets and the economy. And hopefully some nuggets we'll share with you today. It's all charts and graphs, so bear with me. As Josh knows, I'm a chart and graph person, so didn't leave many in the bag today, but we'll try to bring them to life as much as we can. And certainly no shortage of content. We've got an election year as well this year, so lots going on, lots we can highlight. We'll certainly hit some of the key points that we think are driving the story here in 2024. So let's jump right in. And I mentioned good start to the year so far. The stock market's up about 9% so far this year. And that was on top of last year, which it was up 26%. So really good start to the year. We are actually positive in January and February. And that might seem somewhat short term, but it's actually a really good sign for stocks for the rest of the year. You can see that whenever you've been positive for January and February in the stock market, you've averaged another 11% the next 10 months of the year, which is not the best combo. Actually, the best combo historically is a positive January, then you give some back in February. That's what we had last year. But it is better than the other combinations, and certainly 11% on top of how much we're already up this year would end up to be a really good year. And probably the most impressive thing about a positive start to the year in January and February is it seems to lower the likelihood that you actually lose money the rest of the year. So that positive momentum in the first 2 months of the year tends to carry through the rest of the year. Here's all the various January and Februarys going back to 1926. You can see that really since 1938, we've had 34 times where January and February have started positive, and only 2 out of those 34 years did the next 10 months and actually finish negative. One of those years was 1987. More recently, 2011 was down slightly the next 10 months of the year. So I just thought that was interesting history in regards to a positive start to the year. that momentum generally carries through, and at least the likelihood of losing money seems to be a lot less than normal. Normally in stocks, you lose money one every 3 or 4 years. Obviously, if you only lost money in 2 out of the last 34 years, in which January and February were positive, that's a pretty positive indicator for the rest of the year. So hopefully that momentum will carry through the rest of 2024. One feature of this market, I think when you hear a lot about the stock market the last year, the beginning of this year, they talk about how some of the largest stocks have really done really well. And that's certainly been true, that some of the stocks that are the largest stocks in the stock market have carried a good chunk of the return. But the other feature that I don't think gets talked about enough, and something we talk a lot about in Student of the Market, is just how much the market moves up or down on a given day. Can tell you a lot about the market. We measure that by just any day the market's up by 2% or more, or down by 2% or worse. We check that off, we count that. You can see we've had very little volatility in the US stock market here the last year or two. Last year, we only had 2 of these days where the market was up or down 2%. We actually had an over a year stretch where we didn't have any. We broke that here a couple of weeks ago on February 22nd. But you can see that this is what happens historically with the stock market movement. Either it's really volatile and it's jumping around like it did in 2022 when you had 46 days, or 2020 when you had 44, or even back in 2008, you had 72 of these 2% days. There's only about 250 days the stock market's open in a year. So certainly those years were dominated by the market jumping around quite a bit. And then you have these other periods where the market's really stable and really steady. And that's often a great sign for stock market performance going forward. You can see in years in which we have 10 or fewer, so less than 10 days in a calendar year where the market moves up or down by 2%, you average almost 18% in return in those calendar years. Versus years where you have a lot of volatility, you basically average 0 in stocks in those years. And really, this is all about the stock market trying to figure out where the economy's headed, trying to digest where the economy's headed. What is it going to mean for company earnings, company profits, company dividends? That's why it jumps around quite a bit in these periods of economic uncertainty. So that's really one way to think about this. Is the economy on good footing? The market is saying yes, and that's going to translate well for stocks and companies in the U.S. stock market. So this is a good sign for the rest of the year. Keep an eye on it, though. Certainly, this can change quickly if some of that economic concern starts to rise to the surface. But we don't think it will. We think the economy's on decent footing. Certainly, at least as far as we can see through the end of this year. Beyond that, it's always a little bit murky. But we think the economy is still on solid footing, which should translate well for the stock market. Now, one thing I'd like to remind folks, especially at this point where you have some of those individual stocks that have done really well in the U.S. stock market. Microsoft certainly has done really well. NVIDIA, a chip maker that's benefited from the excitement around artificial intelligence. It can make investing in individual stocks seem really easy. But we like to remind folks that there's a reason why we invest the way we do. There's a reason why we diversify and asset allocate and spread your stocks across a variety of different stocks instead of just owning 1 or 2 stocks for your overall portfolio. Is the fact that there's can be a lot of downside risk in only owning 1 or 2 or 3 companies. You can see over the last 5 years that 36% of individual stocks here in the U.S. have actually lost money. And some of those losses can be pretty substantial versus if you invested in a basket of diversified stocks, so a mutual fund, an exchange traded fund, 99.9% of those vehicles have actually made money over the last 5 years. So just drives the difference between owning a diversified mutual fund or exchange traded fund versus individual stocks. And you can see the losses on those individual stocks on the right. A third of those stocks have actually lost 25% or more over the last 5 years. So it's more than that they're flat or slightly down. Some of these have lost significantly over the last 5 years. And this is common. This always happens. But again, just speaks to why we asset allocate and diversify. Of course, one of the big stories in the markets this year in the economy is the Federal Reserve is poised to raise, or excuse me, lower short-term interest rates, really taking back some of what they've done over the last year and a half or so. And you can see that they've raised short-term interest rates over 5%. We're at about 5.5% on short-term interest rates today, which is a dramatic increase, especially compared to previous cycles. But their last increase was in July of last year. So they think they're actually poised to start to begin to lower short-term interest rates this year. So probably second half of 2024, you'll start to see short-term interest rates come down because they're comfortable with the economy being on solid footing. The fact that inflation's come down, never as fast as we'd hope, but still has come down nonetheless. We're at about 3.1% inflation today. So that's certainly a better picture than where we were a couple of years ago. So they can lower those short-term interest rates. Maybe they lower them maybe 1% this year, maybe a little bit less than 1% this year. But that should be good news for both stocks and bonds going forward, really reversing some of the challenges that we saw, especially back in 2022. And just looking at the last time that they've lowered short-term interest rates. So when the Federal Reserve lowers short-term interest rates, what has it meant for stocks and bonds? And one of the big questions is, how does the economy look alongside that? So do we get a recession? Do we not get a recession? The red line is just short-term interest rates over the years going back to the mid-'80s. And then the gray bar is some of those recessions that we've had. So more recently, the pandemic recession was short, but really severe. Then you had the financial crisis back in 2008, certainly very dramatic and severe and lasted a while. The question is, does the Federal Reserve lower interest rates? And do you get a recession within 1 year? That's a big question for stock market performance, especially. You can see these are the periods where the first one is you've lowered interest rates, you've lowered short-term interest rates by the Federal Reserve, but you don't get a recession. Look at what stocks do historically. You average 21% in those calendar years versus some of the more recent periods where you've had the Federal Reserve lower interest rates, but you also ran into a recession as well. Look at the difference. It's a completely different story from a stock performance standpoint. You'd much rather have, obviously, the Federal Reserve lower interest rates, but have that not result or coincide with a weak economy that ends up in a recession. So this, I think, is going to be one of the big backdrops for 2024. If we get the Federal Reserve lowering rates like we think they will, but we don't get a recession, that's a pretty positive environment for both stocks and bonds. You can see both environments are good for bonds. Whenever you lower short-term interest rates, that results in good performance on the bond side. It's that recession, no recession will really be the big driver for the stock market. And of course, a recession is challenging for the stock market because it means lower earnings, lower profits, lower dividends that will bring down stock prices. And another way to look at this is just the fact that this is a good environment for both stocks and bonds, especially because the fact that we haven't yet begun to lower short-term interest rates. I think everybody thinks that lowering short-term interest rates is a great environment for both stocks and bonds. But as we looked at it, that depends whether you get a recession or not. What is actually a nice sweet spot right now for both stocks and bonds historically, especially versus just owning cash, even though cash is paying the highest levels it has in probably 15 years, we're in the sweet spot right now historically. When the Federal Reserve's done raising short-term interest rates, and again, the last time they raised rates was July of last year, to the point where they start beginning to cut rates, that's actually where you get a good chunk of the returns for both stocks and bonds. I thought this was really interesting that the whether you call it a pause or the Fed's on hold, that's a great environment for both stock and bond returns. We've seen that, especially on the stock market, really since about last November. The market got comfortable with the fact the Federal Reserve was done raising short-term interest rates. They thought they'd begin to cut them at some point here in the back half of 2024. Again, good news for both stocks and bonds. And I think, again, regardless of some of the headlines, some of the stories, some of the worries about the election, this is the story for 2024. If they can lower short-term interest rates, avoid the recession, should be a very positive backdrop for both stocks and bonds. And I mentioned cash. We saw a ton of money go into money market accounts, CDs, probably the most that we've seen in 15 plus years. Of course, because these things were paying the highest interest rates that we've seen in 15 years. And in a lot of cases, they're paying more than you can get on a bond or a fixed income investment, which seems counterintuitive. Why would I lock up my money for longer if I can just get more income owning cash or a cash-like vehicle? And so you saw almost $1 trillion, which is a crazy big number in 2023, go into these money market accounts. If you added CDs at the bank, it's probably another trillion as well, versus only about $220 billion into money, mutual funds and exchange traded funds that are in bonds and fixed income. So 4 times the amount of dollars that went in there. But I think what folks don't realize is that even though interest rates were higher on cash, 84% of bonds and fixed income funds actually outperformed cash last year. Granted, a lot of it was year end, November and December, but you still had a picture that even though income was higher on cash, the overall total return on bonds and fixed income, 84% of those actually returned more last year, which I think is eye-opening for a lot of folks. They think most of the return for bonds and fixed income can come from that yield or that interest rate, which is true. But over short periods of time, you can get a total return boost as well if interest rates fall. So this chart looks at the total return for bonds and fixed income whenever cash rates fall by 1% in a given year. So this goes back to the mid-1970s. And you can see that bonds do extremely well whenever interest rates fall. They average a total return of over 12%. But it's not all income. They actually get a total return bump as well. So income was 8% in this example. Another 4% was from a total return boost from bonds and fixed income because they benefit from lower interest rates. The bonds look more attractive as interest rates start to come down. And of course, the opposite was true as well. As interest rates go up, that total return can take away from your income and your overall total return. But I thought I'd just connect the dots there to be helpful to understand that even though cash rates are high, as they start to lower short-term interest rates, you can get this total return boost on your bonds and fixed income investments that can more than make up the difference between income on cash, money market, CDs, and bond and fixed income vehicles today. So we really like bond and fixed income right now. We really think the wind's at the back for the rest of 2024 of those investments. I mentioned the election. Didn't notice if anybody realized there was an election year. Of course, there is. This year, going to be a lot of drama. Election years aren't bad historically. You can see slightly better than average. You average about 10% in stocks since 1926. Just pulling out election years, you average a little bit more, 11.3%. The midterm election years, those are the challenging years. So that's like 2022, the midpoint in the cycle. And then odd years tend to be even better, like last year. And certainly 26% in U.S. stocks last year just added to this total. But I thought that was interesting just to highlight that election years aren't bad for stocks, tend to be actually a little bit better than average. So don't let that derail you. And don't get caught up into who's going to win, who's going to lose. And don't let that drift into your portfolio. This is a chart that we did just looking at the last 10 years. Had you invested $100,000 in stocks, it actually grows to over 300,000. Not too shabby considering you've got some negative years in there. But look what happens if you only invested when a Democrat or Republican was in office. All of a sudden, your result goes in about half. That's certainly not what we want to see. Don't let your investment plan get derailed by your politics drifting in. You don't want to interrupt this compounding, the magic of compound interest over time, letting that stock, letting your investment plan work for you. And we can drag this out over a much longer time period. This is over the last 70 years. Same thing, looking at if you invested the entire time versus just investing when there was a Democrat or Republican in office. Look at the difference in the outcome here. $1,000 back in 1953 when Eisenhower was in office grows to over $1.5 million. But if you take some of that money out, depending on which party you support, interrupting that compounding has an enormous impact on your outcome. Don't fall into that temptation. The drama is going to be thick around the politics. But when it comes to the market, when it comes to the economy, a lot of the longer term direction and momentum that both the market and the economy has can overwhelm some of the short-term political noise. Don't underestimate that. We see that consistently throughout history. And the last one, and Josh probably knows this one well, we've done this one several times, but I always think it's a good spot to land all these charts, is just to remind folks why we build portfolios the way we do, why we asset allocate and diversify, and spread your investment eggs across a variety of investment baskets. It's all to get to what we see on this slide, which is what we call winning more by losing less. If you remember that riddle, sounds like a riddle anyways, winning more by losing less. You don't need all the upside of what the bull market brings. Just get a chunk of it, but limit losses in the downturns as well. You're still going to lose money when the market's down. And certainly no better example. Look at this diversified 60-40 stock and bond mix. Back in 2008, you lost almost 30%, one of the worst years ever, by the way, for a diversified portfolio. But then on the other side, when prices go up and the bull market returns for stocks, you trail. And look at this dynamic over time where you lose money, you trail, you lose money, you trail. Last year was another trail year. Don't lose sight of what we're trying to do as we build portfolios. Get a chunk of that upside. You don't need all of it, but limit losses in the downturn. That's how you build wealth over time. It's just tough emotionally as you go through it to see it play out because it never feels good to lose money. It never feels good to trail, especially when you trail by a lot. Feels like you're leaving too much money on the table. Of course, the punchline here, as Josh knows, if we add up this 20-plus year stretch, the diversified portfolio actually wins, even though it didn't necessarily feel good at each stretch along the way. In fact, most of the time it doesn't feel good. But I think it's good to connect those dots and remind ourselves why we build portfolios the way we do. Even some of the best investors we work with need this reminder from time to time. So hopefully a good place to land this one. But think about where we started. Good start to the year, especially on the stock side. That momentum often carries through to the rest of the year. We think it sets up well for the rest of the year, especially if we don't get a recession on stocks. Bonds, as short-term interest rates and the Federal Reserve start to lower those rates, that's really good for bonds in general. But as long as we don't get a recession, that'll be good for stocks. We don't think that'll be the case. We don't think there'll be a recession in 2024. So that should be good news for both stocks and bonds. And of course, don't let the politics get into your portfolio thinking. You don't want to derail that compounding over time, and lean on that diversified portfolio, right? Doesn't always feel good, but remind ourselves what works over longer stretches. That's really the main lesson that we always lean on, but especially in periods where you have some fear and uncertainty and the drama will be thick, remind ourselves why we build portfolios the way we do. So why don't I stop there? That's probably enough charts and graphs for a Thursday. Love to hear what's on everybody's mind, though.
Thanks again, Mark. That great presentation, as always. Great information. And for anybody that would like to ask a question, feel free to type that into the chat feature here. And Mark will be happy to answer those questions. I've got a couple for you. Mark, questions, comments, actually. So Fed came out yesterday, or I guess was it, yeah, yesterday, and they've declared, I guess, a potential drop of three different decreases in the Fed rate before the end of the year, and that obviously made the market skyrocket. Um, Question that I have for you, and just thoughts on this is, here in Texas, the real estate market has certainly slowed down, but as the interest rates drop, I think that's going to skyrocket real estate again. What are your thoughts on that?
Yeah, it's really been one of the most interesting stories here that probably doesn't get covered enough is what's happened to the real estate market, especially residential real estate. Think about, wasn't that long ago that we had 3% 30-year mortgages, right?
Right.
Where it was very cheap to finance a home. Today, those rates are 6, 7%, right, on a 30-year mortgage. So more than double. Yet housing prices have held in really well across the country. And this is one of the biggest things that nobody touches on is there's such a lack of inventory of houses out there. It's really held prices in there, even though the cost to finance a home has almost gone up by twice. So I think that dynamic just is not going to change anytime soon. There's just not a lot of inventory of new homes. In fact, higher interest rates has exacerbated that inventory picture because folks who are sitting on a mortgage that is in that, you know, 3, 4, even, 4.5, 5, they don't want to sell their home, even though their home might have appreciated a ton in value. They don't want to sell it and reset a new mortgage at 6 or 7%. That doesn't make a lot of sense, right? So you have folks that just aren't as willing to sell their homes as they might have been in a lower interest rate world. So we've had this massive underbuild of homes in the US, really going back to the financial crisis. So you look at the financial crisis, that was all a big housing bubble, right? And challenge. They took out a lot of home builders, a lot of those marginal home builders back then. And we just have underbuilt homes dramatically since then. And now you add on the fact that higher interest rates are keeping folks in their homes longer because they don't want to reset their mortgages. That inventory picture is a challenge. So it's going to keep prices high. You're right. If interest rates start to drift lower, right, maybe folks can start to finance homes a little bit cheaper and thus pay a little bit more. Maybe you see housing prices drift higher again, although they do seem at fairly elevated levels at this point. I've seen you. I think some of the hot markets you've seen them come down. I mentioned Josh. I'm in Arizona, so we've seen those prices come down from the crazy levels, but they're still elevated, right, compared to where we thought they'd be, given the much higher interest rate world that we're living in. But it's certainly something that I think has helped overall consumers, right? If folks feel like they have a lot more money because their house is worth more, they tend to spend a little bit more. That wealth effect that certainly, especially when stocks are up like they've been. So I think everybody feels a little bit better about their situation because even though rates have gone up, it hasn't really impacted their housing value in a big way. Certainly hasn't impacted their stocks in a bad way.
Yeah, I agree. I think that's a future opportunity for real estate and even commercial real estate at that. And that a lot of the commercial real estate, not here but nationally, is suffering right now. That might be an opportunity for investment for the future. You hit on a kind of a theme right now. People are investing into cash heavily right now because they're getting such nice rates. And your slides showed beautifully how the true opportunity is in bonds for those fixed rates for the rebound of bonds because they've just had a couple of spare years here where there's the opportunities in the future. So I think that's some interesting information that I had not seen yet about what happens to those high yielding accounts whenever the rate starts to drop.
Yeah, I think that's it's counterintuitive for the most part, right? You think about just take the investment that's paying you the most, and certainly cash and some of those shorter term investments are doing that right now. But like in a lot of things investing, what seems like the simple, obvious choice is never the best longer term option.
Yeah.
And we're just in that environment right now with cash, where you're seeing money pour in to those money market accounts and ignore some of the opportunities that are in bonds and fixed income because they just look less attractive because they're paying a little bit less. But we talked about the total return potential as interest rates come down. So for me, I think that's one of the big opportunities that we're going to see in the back half of 2024. We've seen interest rates inch back a little bit higher after a really big rally at the end of last year. I think that's a great entry point for folks here for bonds and fixed income, really across the bond and fixed income universe, right? We don't even need to get particular and say, oh, we love this section versus this section of bonds and fixed income. I think it's going to help them all in the back half of the year. As short-term interest rates come down, some of those cash interest rates can come down pretty quick, and folks can get blindsided by that as well. But it's just one of those classic investment opportunities where it doesn't seem intuitive, it seems backwards, but history tells us that this is really the sweet spot to put money to work in bonds and fixed income, along with the overall portfolio. And we've seen the rally in a big way on stocks. We haven't seen as much on bonds, which I think is still out there.
Yeah, great opportunity. Well, very good. Well, Mark, I don't see any questions coming through. So as always, thanks again for all the great information, and we look forward to seeing you again in the future.
Absolutely. Thanks, everybody. Thanks, Josh.
Have a good day. Bye-bye.